With CI Futures, you can access AI-powered market forecasting for as low as $20 a month. Get 94.7% market forecast accuracy for over 1,000 assets across commodities, currencies, equity indices, economics, and stocks. With weekly updates, 1-month and 3-month error rates, and top 10 and bottom correlations, you can rely on CI Futures to help you make informed decisions. Join a growing number of satisfied users who have already transformed the way they invest with CI Futures. Don't wait. Start forecasting with confidence today for as low as $20 a month.
Hi, and welcome to the Week Ahead. I'm Tony Nash. Today we're joined by Deerpoint Macro. We're joined by Fabian Wintersberger, and eventually we'll be joined by Albert Marko. So this week has not been a boring week. There's been quite a lot going on this week, and we really haven't had a boring week for quite a while. So the first thing we're going to talk about with Deer is US banks, and is there kind of a looming credit crunch coming? We're next going to talk about the ECB and Europe's banks with Fabian, and finally we'll wrap up with Albert talking about the debt ceiling, both the politics around it and kind of the reality of it, and I guess will we ever not have a year where there's a dramatic debt ceiling kind of crisis? So, Deer, let's started off with you. This week, obviously, you can't avoid it. We've seen a lot around U.S. regional banks, right? This chart on the market cap of U.S. regional banks was published earlier this week, and we're looking at the value of regional banks being about a fifth of what they were in January, which I think is pretty shocking when we see it in one place. So you put out a great tweet this week showing that deposit rates are pushing depositors out of banks and into money market funds. The reasons are pretty obvious when we look at the chart at the rates that they're getting in money market funds. I guess the real question is, how do depositors catch up?
Yeah, so that's the real question. And I think if we look at what's happened over the last 14 years, Mike Green actually touched on this a couple of days ago, and I quoted him in that tweet. It's what could banks have really owned to be able to pay 4 or 5% on deposits? And I mean the answer really is nothing, right? Because if you look at the only thing that has really yielded 4% over the last 14 years or so, it's been in the high yield market. And then obviously you have all the credit risk that's associated with that. What's also now been exacerbated is the stickiness of those deposits. And I touched on something last night as well on another post where I was kind of looking at some data that the New York Fed posted. And essentially what they found is that if you're to look at a 1% change in the effective federal funds rate, the actual beta for deposits is about 26 basis points. And for money market funds, it's about 88. So the elasticity of money market funds is it's much easier for them to fluctuate along with the change in the effective federal funds rate. But like I've said, just over the last 14 years, deposits have just become so sticky. And I think that's broadly a function of the fact that there hasn't been anything, an investment grade paper or otherwise, that would have allowed them to actually be able to pay 4% on deposits. And I'll kind of end that here as well, is even I know some people say, well, they can go to, they have the ability through excess reserves, and they the Fed's rate, you get the Fed rate plus 15 basis points, and obviously banks can then pay deposit holders at a rate below this, obviously to ensure kind of that net interest margins are suitable. But even, I mean, that is something that has just now happened, where you have a federal funds rate at 400 or 525 basis points plus the 15 that they get. Broadly over the last 2 years, they wouldn't have even had enough to be able to pay out, 4% on deposits. So I think that that's really been the problem for banks.
Yeah, I was on the board of microfinance bank in Cambodia for several years. So the precision with which U.S. banks are managed is just fascinating to me because I watch, very closely, or they can watch very closely every single move that they make, right? And so I think one of the interesting things about this flock to money market funds for me is back in 2008, we saw money markets break the buck, right? Money market funds break the buck. So it almost looks like a risk-free approach, but there isn't a downside now, but there are downsides both ways in each of these vehicles, right? So you put out a great chart that also talks about banks provisioning for losses. Can you talk us through that? And we're not quite hitting kind of 2007, 8, 9 losses yet. And definitely we're not hitting the 2020 losses. But what is this telling you?
I actually think that it is telling us that banks are practicing practical cyclical risk management. And what I kind of mean by that is, obviously everybody's been shouting that we're going to have a recession for the last, 2 years. And when it doesn't come, they just push the forecast forward. But, I think what banks are preparing for is some sort of credit cycle. How deep will that be? I don't think anybody knows. I think when you look at provisioning, what they're saying is, okay, we need to go ahead and start positively provisioning. We need to start, increasing provisions for credit losses above gross impaired loans. And this is just kind of a way, I would say, to manage possible risk that, once it's there, banks are already in a position in which they have enough of a buffer in that ratio between, provisions for credit losses against gross impaired loans, that they are very comfortable. Obviously, that does come at the detriment of earnings. But, currently, I think a lot of U.S. banks can kind of make that up if you kind of look away from retail, banking and look more at capital markets. I think currently with conditions there, they can kind of make up any losses that they would really feel from positive provisioning on the capital market side.
Okay.
But obviously, if we have an overall slowdown, I just think that, banks are being very, very, let's say, tactful in the way that they're actually going about preparing for any sort of credit cycle.
Okay, that's good. That's respectable. So if there is tighter credit, who gets hit first?
That's a good question. I would say it's probably going to end up being, middle America. And then I would actually say that it probably flows through into Europe. In kind of the offshore dollar funding markets. I mean, obviously that gets a little into shadow banking, but what happens then is then again you have a money market fund issue where once this credit starts to kind of contract, a lot of those European banks or actually the money market funds, they have outflows. And so therefore they're not going to be there purchasing commercial paper. They're not going to be there purchasing certificate deposits. And then obviously that leads to funding issues on the dollar side for a lot of European banks. So I think that tightening of credit is actually probably going to have the biggest flow through into offshore dollar funding markets. And you can look at that kind of by dollar funding cost, which is the implied rate minus 3-month LIBOR, or I guess you could use SOFR now, or you could look at that through, cross-currency basis swaps as well. And that's kind of a gauge of dollar shortage of dollars against, other currency pairs.
Okay, so we see the most dramatic contraction in the euro dollar market first, right? So it seizes up overseas first. So that's going to hit EMs, then it's going to hit other markets, then it's going to come back to the US. Is that what you're saying?
Yeah, that's what I would believe would actually happen, and that's I would argue kind of what we saw in the beginning of COVID. You saw a really seizure in dollar funding markets, and you saw the basis widen. If you were looking at cross-currency basis swaps, you saw dollar funding costs overall increase dramatically, and obviously that puts a lot of strain on the global capital markets, but especially Europeans, just as a function of the fact that they don't have access to US dollar retail deposits, but they use a massive amount of dollar denominated, let's say, assets to fund long-term portfolios, and other kind of funding needs that the Europeans have. So I would believe it would kind of flow through in Europe and then come back around. But I mean, we'll probably see credit contraction at least in Middle America. But if you're Apple, I don't think even in a credit cycle you're going to have problem getting
Sure.
access to debt markets.
Okay, but looking at those U.S. markets, is the first person that's
That's the
sorry,
same game plan as 2012, Tony.
same game plan as 2012. So then the guys who get hit
Yeah,
are
same thing.
mostly
European crisis because of dollar shortages and leaked over here.
okay. So domestically, is it mostly small businesses who will get hit?
Yeah, I would say yes.
Okay. Okay.
And
So
and even the NFIB, you can see that. Like if you look at the NFIB, what is it, credit availability? Next 3 months, that's contracted quite drastically.
okay. And so is this why the Russell is lagging other markets and why it's been so hurt over the last several weeks as well? Because small company credit conditions in small companies are tight.
I would say yes. Yeah.
Okay. Okay, very good. So, and then let me kind of ask you one more question about one of your tweets about credit default swaps. You put out a chart a couple of weeks ago about 5-year credit default swaps for U.S. versus European banks. What is this telling us about risk in each of those banking areas, Europe versus the U.S.?
Yeah, so if we look at credit default swaps, obviously they're elevated, at least in the US context, still not as bad as they were kind of in the beginning of November of 2022, as people can see on that on the chart. Obviously there's still risk in the US. I do think that broadly speaking, people are relatively are somewhat relatively rest assured that the Fed will kind of do whatever it takes. If we look at Europe, on the other hand, where I think that European are lagging, is that if we look at European credit default swaps, they kind of lag what are called CoCo bonds or Tier 1 capital bonds. And so we've seen a massive change in the underperformance of perpetual CoCo bonds. And I think that that's actually now starting to kind of flow through in credit default swaps. So those perpetual AT1s are much more susceptible to changes. So they fluctuate. They're kind of a leading indicator of what's going to end up happening with credit default swaps. And so obviously we've seen, people worried about overall, I would say, banking health. Europe's been, kind of more of a victim of that with, people talking about before the whole US thing, it was Deutsche next after Credit Suisse, et cetera. So there's been a lot of change in investor sentiment in terms of credit profiles. Therefore, we've seen perpetual AT1s underperform. So that means that the yields have gone up. And so therefore, I think those credit default swaps in Europe are just now starting to kind of catch up with where, those Tier 1 capital bonds were trading at.
So this is what happened with Credit Suisse, right? All those AT1 investors are like, oh, this is secured, no big deal. I'm going to buy into some AT1s while they're discounted. And then the Swiss National Bank came in and said, no, that's not really the case. And they blew them out. And so is this why things are a little bit more difficult in Europe?
Well, I would say yes. For people to kind of understand the importance, I mean, it's not a huge market, right? I think it's like $260 billion. But the thing is, a lot of banks hold these. A lot of pension funds hold these because they have drastically outperformed holding European banking stocks, right? So if you're a portfolio manager, you've done a lot better holding perpetual CoCos than you have owning European banks. And really, perpetuals they perform extremely well when you don't have, bad macroeconomic data or problems in the financial sector. But now that we're seeing that, I do think that a lot of these investors are going to be on.
Okay, great. So Albert, Deere said something about the Fed will come to the rescue. And I know that you have said some things about this over the past few days. And first of all, thanks for joining. I know you're super busy, Albert, and I really appreciate you coming on. So, do you believe the Fed will come to the rescue for these regional banks?
It depends on the regional bank.
Okay.
Bigger banks that have small business exposure, specifically the loan, SBA loans and whatnot. Yeah, I do think they're going to come to the rescue of those banks. They sent out a warning maybe like a week or two ago where they said, the coastal banks are doing their part and tightening lending and whatnot, and then called out the Midwestern and Southern banks, not by name, but pretty much alluded to it. So that signified to me that they want to press the banks to stop lending. That's their way of tightening at the moment. They can't tighten because there's not really too much liquidity in the market for the Fed to take. So what do they do next? They use the banks to do it. They'll like other people have been saying is, credit's drying up, and that's
right.
That's part of their game plan at the moment.
Well, this is the traditional monetary transmission mechanism. This is how it was designed in the beginning, right? With the Fed providing liquidity, banks transmitting that liquidity out to borrowers. And then if the Fed wants to kind of sop up capital, then the banks are really the primary means for that happening. So, and it seems like the immediacy of this is with the smaller banks more so than with the larger banks. Is that fair?
Yeah, I mean, the larger banks are going to play ball, right? The smaller banks need to chase profits, and they got margins and shareholders to deal with. They need money. They keep lending, and they kept lending. You can see that in the housing market. The surprise 10% up, in sales because people just kept getting credit, and
right.
They need to stop that. I mean, in their perception, they need to stop that lending.
And so, Albert, with some of these coastal banks that are in trouble, is it their portfolio? So, to me, I could be wrong. And Deere, jump in here. Is it their deposits that are leaving, or is it their lending portfolio, meaning commercial real estate and other things, that is the bigger concern for investors? Albert, you go first.
Man, that's a little bit over my that's a little bit over my pay grade. But from my perception, is it's not really so much the deposits, but the risky lending that they've practiced over the past few years. I mean, SVB was using G5s as collateral for clients buying G5s. So it's like,
right.
It's like that all comes into question, and how they manage their risk, which they really didn't. So that's the problem in my view.
Okay, Deere, do you want to come in here? Is that relevant and accurate? It's more their loan portfolio than it is the deposit, say, run, which seems to largely be over.
Yeah, it's actually very interesting, and I'll be posting something on this today because I actually just finished it up yesterday. But I was looking at the proportion of loans to deposits, and so if you look at the U.S. banking sector in aggregate, right? So the entirety, large banks, small banks, all of them combined. Deposits are roughly about 16 trillion. Loans are roughly 10. So there's a massive base between current deposits to loans.
Wow.
And then if we kind of actually start to look at the proportion of loans to deposits for the large U.S. banks, if we kind of break it down between large and small, the large U.S. banks, they're about 63% in their ratio to loans as a percentage of deposits. What is actually very interesting is that the small banks are actually far higher. So current loans account for over 80% of deposits. And so if you actually start to look at, loans to deposits, it's actually in fact weighted much more to large commercial banks than it was small banks. And so, I actually think that a lot of these deposit flights we're seeing is actually the fault of the media, right? It's much like what was that movie where the bank run, I forget where he's like, oh, there's if that's a bank run, if I've ever seen one. Well, if you get on Twitter, like every day, people are like, oh, PacWest is screwed. This
Right.
bank is screwed. It's screwed. So like if you're
It's
just
a
an
wonderful
everyday
life.
Joe,
It's a
yeah, it's a
wonderful life,
wonderful
right?
life.
Yeah.
Yes. Thank you.
Yeah.
So if you're just an everyday Joe who sees this, these accounts with 200,000 followers saying,
Right.
take your money from PacWest, what are you going to do? So I think that, this is actually really the fault of regulatory oversight. I know in Europe, I know in Canada, you can't come on TV and say X bank is screwed
Right.
without tremendous evidence to back that up. And I mean, we saw that with SVB when they came on and they were like, oh, as SVB screwed, after what, like almost a couple of hours after that aired, everybody was freaking out that SVB was over. And then,
Yeah.
we had the cascading effects of that. Like you can't do that in a lot of countries. So this fact that we have people who can kind of come on and fearmonger,
Right.
obviously, if you don't know any better, and you're just somebody who sees this headline flash across, your news feed or on your cell phone, you're going to freak out if that's a bank that you bank at, and obviously it's going to cause you to pull your deposits. And I do think that a lot of these banks are relatively healthy, and I think that they're actually extremely important. So I mean, I think that it's also a function of just bad regulatory oversight that
Yeah.
somewhat we're allowed to be able to do this.
Yeah, I spent most of my life in
Yeah.
Asia, as most people know. And if that stuff happened in Asia, people would be in jail for manipulating markets in just about any market there, I think. And so it's strange how social media commentary is allowed in the US to manipulate markets, and it's not prosecuted by the SEC. I mean, this goes from, go ahead, Albert.
You have all those crypto and gold bulls out there saying dollars dying, banks are ending, and buy this and buy that. It's shameful. I mean, the SEC needs to really step up on that sort of stuff.
Yeah, they do.
I mean, I've seen like very popular financial guys out there on Twitter saying the same thing just to pump their retail services. It's absurd.
We see that all the time. Fabian, you wanted to jump in?
I mean, as we talk about the credit crunch, isn't this exactly what the Fed wanted to have? I mean, they raised interest rates, the bond credit to tighten, and I think the main problem is that they kept interest rates for so long that all those banks have a lot of assets that yield basically nothing, and so they can't raise the deposit rates.
Yep. Dear Lemon, I want to ask that to you, but before we get to that, I want to say, with all this information on social media and other things, your average depositor, even your well-educated depositor, generally doesn't understand the banking system, right? I mean, you just heard Albert say, and he's a very educated guy in financial markets, say, well, that's kind of above my pay grade. And I observe financial markets. Fabian observes financial markets every day. I don't know that I would never consider myself a banking expert, right? So your average person saying, pull your money from, First Republic or whatever, it's kind of terrifying. So this stuff is really, if there is a regulatory issue, I think part of it is that some of these people really need to be at least investigated to see if they violated applicable laws, maybe not prosecuted, but at least investigated. But dear, I think Fabian raises a great point about the credit crunch. So are we going to see a significant credit crunch as a result of the Fed's actions and some of these kind of higher visibility on some of these regional banks?
Yeah, so I would I think that the credit crunch is coming, but I kind of broadly adhere to Milton Friedman's philosophy of the interest rate fallacy, where he said, and we actually saw that when interest rates were increasing recently, you actually saw increases on a year-over-year basis of volumes of credit issuance. So if you were to look at loans and leases at all commercial banks, while interest rates were increasing, banks were also extending more credit. And so I think what happens is when we talk about the low interest rate environment, we think of that through like a present value kind of calculation, where if I'm a consumer and I'm doing a present value calculation and interest rates are, on a mortgage, what was the low? Like I think people were getting them at like almost 300 basis points. Obviously, things become very attractive. But on the supply side of that equation, if you're the bank who has to decide who to lend to at what price, you're going to actually tighten credit. And so kind of it's a bit against conventional wisdom, but what Friedman pointed out is that essentially when rates are low, it's because credit has been too tight. And when rates are high, it's because credit has kind of been too loose. And we actually see that because once the rates start to rise, it becomes obviously more profitable for banks to lend. So what do? You have banks come in and you have kind of the supply curve shift to the right, where they're now going to start to supply the market with more credit. And so it's kind of this very interesting thing where it actually seems that consumers are really overall agnostic to what rate they take credit at. And obviously you see that because if loans and leases are increasing, that means somebody has to be, asking for loans for banks to be extending credit.
Right.
And so I actually think that now that credit is contracting in the face of higher rates, this is really going to pose a bit of an issue for the Fed as well, because now if there's no access to credit markets, or if interbank liquidity becomes super inelastic, you have massive funding issues in capital markets.
Yeah, the impact of Fed policy is more direct when money's tighter, right? So each time they raise, as the money supply contracts, it's more immediate. The impacts are more immediate for the market. And so, I think all of this makes a lot of sense, but we all need to relearn this every cycle. So CI Futures is our subscription platform for global markets and economics. We forecast hundreds of assets across currencies, commodities, equity indices, and economics. We have new forecasts for currencies, commodities, and equity indices every Monday morning. We do new economics forecasts for 50 countries once a month. Within CI Futures, we show you our error rates. So every forecast, every month, we give you the 1 and 3 month error rates for our previous forecasts. We also show you the top correlations and allow you to download charts and data. You can find out more or get a demo on completeintel.com. Thank you. So let's move on to Europe. And Fabian, Deere had a chart about 5-year CDS in the US versus Europe. And you sent me a chart that you did asking, are European banks really in better shape than US banks? So can you talk us through that? And are you worried about more kind of wreckage or distress in European banks?
Not immediately. I think European supervision has been much better than in the US, and we didn't deregulate financial markets as much. That doesn't mean that some banks might have mismanaged interest rate risk, but yeah, I think the problem has started, as we can see in the chart, during the GFC, European and US banks went down, but Europe's banks never recovered, and that's, in my opinion, because the ECB never raised interest rates, and so banks had, and the bread and butter of banks is to lend money, and yeah, rates were so low spread, and that's exactly what Dia said. If interest rates are too low, then the banks thinks about real economic investments. They say, well, why should I lend money for 2.5% if I just can put it into treasuries and get 1.5 or so?
Right.
And
or with negative interest rates, they're punished for holding money, right? So it's,
yeah,
it makes sense to me, and their profitability was razor thin. So
yeah.
that makes a lot of sense. So can you help us, what is the ECB doing in terms of the banking crisis? We saw Madame Lagarde speak earlier this week. We saw a 25 basis point rise. And do you think that's the right pace? And where do you think they'll head next?
Well, I was hoping for a 50 basis point increase because I thought it was justifiable. But yeah, I think she referred to the bank lending survey on why the ECB just raised by 25 basis points. And yeah, in the lending survey, you can see that drop in lending growth across the board. I think demand for corporate loans in the first quarter was had the biggest drop since 2009. But on the other hand, you have growing net income for the banks, and they had extremely good numbers in earnings. So I'm not quite sure if they took the correct path. I think and as yields have dropped prior to the meeting, and so I thought, yeah, they have the room to go for 50, and maybe then they could think about what to do next, because now we just know for sure that there's another 25 basis point hike coming. And yeah, I don't know. I think the ECB is praying that inflation will drop similar to the US because yeah, otherwise they are in a very tough spot.
Yeah.
And I'm not so sure about that because if you think about why, I mean, inflation is that high in the euro area because on the one hand, the ECB is tightening, and on the other hand, governments are handing out fiscal stimulus. You get price caps for energy for consumers. Now, I think German Economic Minister Habeck talks about price caps for German industries. And yeah, who's going to pay the bill? The government pays the bill. And if the government pays the bill, it's you paying the bill.
I mean, if anybody has the budget for it, Germany has the budget for it, right? So,
Tony, this is exactly what we talked about a couple of weeks ago, where politicians have a short-term view of their political careers rather than sound economic policies.
Yep. So, and let's be honest, it's central banks and fiscal spending that got us here, right? And if you pay people to stay at home for 2 years, you have to turn around at some point. And so for all of the slack time people had in their jobs, and for all the slack that we had in the economy and in the fiscal environment for 2 years, the other side is extremely painful. And some people have been saying that for a while, but nobody really wanted to believe them. So, it's a tough spot. So in Europe, Fabian, is there, so are the local banks as stressed as some of the regional banks here are in the US, or is there a pretty uniform kind of view of banks across Europe?
It's hard to say. I think currently the regional banks are in a good situation, I think, because the regulation works better than in the US. And we have another positive thing, which is positive for the banks, of course, because I think you had it in the US too. You had credit guarantees by the government, and in Europe they're still in place in many countries. So they never lifted it. They're handing out credit, and the bank lends because they know they get the money anyway. If the data falls out, you get the money from the government, and so I think that may be helpful, that the banks will continue to lend. And basically, it's exactly what Russell Napier talks about, I think since 2020, that's the way how to keep credit flowing and to keep inflation a bit higher, so you can bring the debt to GDP ratio down.
Yeah, we may have to do that in the U.S. again,
Yeah,
for a short period. I mean, I don't know that there's any other way around it without having some pretty hard lessons learned. So I mean, I could be wrong, but it seems like we're headed there, at least for a temporary period. So, okay, thanks for that, Fabian. Let's talk about the debt ceiling now. Everyone's really favorite topic, I guess, aside from banks. Albert, I know you're all over this, and I know that you talk to folks on the Hill on a regular basis. And you sent this great tweet out earlier this week. Someone said that the U.S. government, Mark Zandi, who's at Moody's, said the U.S. is going to run out of cash on June 8th, and you said, lol, okay, sure, LOL, okay, sure, right? So the debt panic story started a couple of weeks ago, maybe a month ago, I don't know. To be honest, to me, it feels like the same fake drama that we see every year. And I think a lot of Americans are just cynical about the debt ceiling discussion. So now that it's May, we keep hearing that the U.S. government's going to run out of money by a certain date. From your perspective, do most Americans really care about that? Like, we kind of have an antagonistic relationship with our government, right? So on some level, most Americans just kind of shrug shoulders. They're like, okay. So what's the popular opinion there?
Well, I mean, from the public's point of view, they don't care if the government shuts down. They want them to shut down and stop spending money. But I mean, for the markets, which is what we care about, debt ceiling is a bit of an issue. I mean, it's an issue only because of what the narratives that it provides for market movers, right? That's the only issue, because we're not going to run out of money. It's not. Right. It's just not going to happen. Yellen's going to prioritize what she needs to, and the United States will be fine. The problem is pretty much in D.C. at the moment for the Republicans and the Democrats to come together to get a bill done. They're so far apart at the moment that I don't see any kind of resolution happening before June 1st, whenever the theoretical line of death is that they put out there. Because McCarthy, if he caves, he can be ousted as a GOP leader, which then would cause a bigger problem in a second. And because people don't realize that if he's ousted, there's no process to get bills done until they find a new leader, which could take weeks or months for this matter. And Biden and the Democrats want a clean bill with infinite spending and zero restrictions, which is just outrageous. And it doesn't even have a chance to even get to that point in the Senate, with Sinema and Manchin coming out against it just today. But they don't have 60 votes for that. I don't think any Republicans would even go for a clean bill on the debt ceiling. So it's something that we're going to have to deal with, because it's going to be a scapegoat for the markets. And we have to, keep an eye on it at the moment, just because of the narrative.
Right. And so for people who aren't in the U.S., the House of Representatives has what we call the power of the purse. So a lot of this budget stuff has to be approved by them. And Kevin McCarthy has a very delicate coalition in the Republican Party to stay in power. And if he doesn't keep some of these budget hawks on his side, he will lose his seat. Someone will call a vote. He'll get a vote of no confidence. There will be no majority leader with the Republicans, and so no legislation will come to the floor. And so
that's right.
Then the legislative branch is deadlocked, right, until somebody else comes, and be a very difficult fight to get something done, right? But I think it was important, Albert, to also explain to people, especially outside of the U.S., the view of the debt ceiling from kind of the people who are kind of exasperated by D.C. versus the view of the debt ceiling from the markets who deep in their heart know this is going to be resolved, but play to the narrative just to get it done as quickly as possible, right? And so, so will the U.S. government actually run out of money? And I guess, again, this is kind of a technical thing, but will U.S. government employees go without pay? I mean, this is something that always comes up with the debt ceiling. You know, the poor bureaucrats of the U.S. government, are they going to go without money?
Some will, and it'll be for a short amount of time. And
right.
It's more of a political question where it depends on which workers go without pay. That'll maximize the pain for the opposition. That's just the way.
Right.
That's the reality of it. I mean, it could be teachers or
Right.
something in the government. They'll target somebody in the government that's got like vacation time coming up, but they're not getting paid technically. So,
Right.
but no, I mean, there's not the government's not. The U.S. is not going to run out of money until about September, anyways.
Right.
So
exactly.
This whole June 1st thing is a little bit silly.
Right. So the executive branch always cuts the most visible jobs, right? So it's the people
Correct.
that say national parks during tourist season who are showing people around. So they have to close national parks to disrupt people's vacations. It's people that say maybe the VA so they can pull on heartstrings around healthcare. It's, those sorts of guys who are being kind of cut. But make no mistake, those guys always receive their back pay. Even though they're not working, they will always be compensated for the time that they were off. So nobody is going without money. It may be delayed, but nobody is going without money. Nobody is going without health care. Nobody is going without benefits, right? And so these guys are always get a big paycheck at the end of this for the time that they didn't work. So they're literally just taking time off, okay?
Pretty much.
So when we hear statements that are, say, quote, kind of the full faith and credit of the U.S. government, right? We have these guys who were 140 years old on Capitol Hill in the executive branch talking about the full faith and credit of the U.S. government. What does that mean? Does that mean anything?
Not to me, it doesn't.
Right.
I mean, there's nobody else in the world. So I don't know what they're talking about. I mean, it's just PR jargon for them to
right.
push out agendas and narratives. That's all it is to me.
Right. These are sympathetic words that people use to get emotions on their side. And so, again, I think most people who hear this, for some reason, it touches their heartstrings, but it really doesn't mean a lot because everyone knows that the U.S. government is going to pay their bills. And so,
of course,
how do you expect this to play out, first of all? And second of all, will anything change this time next year?
No, I mean, the most likely scenario is they get a 1-year funding deal with some spending cuts and probably leftover COVID money out there, which the Republicans have been trying to get rid of anyways. I mean, Biden realistically is going to have to negotiate at some point. It's just when, and I think it'll probably towards the end of May or early June. And, you could have a little bit of drama for a week or two, but, something will get done. It always gets done.
It always gets done, right? And my guess is it'll go into the second or third week of June just to make it really painful on all of us so that we don't want to read any news anywhere.
No, of course, and this is political season now because the primaries are starting to gear up, campaigning and whatnot. So, Biden and the Democrats, and as same thing with the Republicans, want to scapegoat things. If the market drops, they need a scapegoat. Yep. So debt ceiling it is. Let's see what party takes the brunt of it.
Yeah. So let's look at kind of the next week. Okay, we've seen a lot of banking stuff happen over the last week, and a lot of we saw Apple report, and it was good, then it wasn't so good, and So what do you guys expect to happen in markets kind of over the next week in the U.S. and Europe? But is it more of the same? Are we on this kind of do a down cycle, or are we going to see chop as different, say, data like today's NFP come out and it's higher than people expected, so maybe it's changing sentiment one way or another? Albert, why don't you get us started?
Yeah, so for the week ahead, I mean, honestly, for me, is what the market's going to price in for a pause versus a rate hike. I mean, today's numbers definitely show that another rate hike's probably coming. Um, Aside from that, it's regional banks and how much pain they're going to go through over the next week, and what the narratives are around that. And I don't really see a solution for that until Congress agrees to up the FDIC limits to 500,000, which the GOP has no appetite to do. So, I think the next week into 2 weeks is regional banks and a little bit of topsy-turvy. I mean, you would expect a little bit of a sell-off because this market's way overvalued, but God knows with these, tech earnings beating.
Yep. All right, Fabian, what are you seeing for the next week, especially in Europe?
I see basically more of the same because
Chop.
I think I think that probably yields will I think long-term yields they won't rise much. I think they will edge lower a bit because I think it started on Wednesday with Powell this week. I think that markets just doesn't believe any of the higher for longer talk. And if you look at Fed history, that's probably justified, especially in a high inflation environment, because I think I've read that in environments with high inflation, the Fed basically cuts the next month after they reach the peak.
Right. Okay.
And in a low interest rate environment, I think it is 4 months. And I wrote about that in my Substack today, that I don't think that Powell is done yet.
Right.
And I checked the Fed Watch tool, and I think that the probability of a pause was around 99%.
Yeah.
And
that'll go down over the next month.
Yeah, I think so too. Because I listened to the press conference and he was really hawkish. I think he was. I didn't expect him to be that hawkish. He always talked about excessive demand, wages. I mean, what I liked about it, that he said that wages do not cause inflation, because I think that is correct. And that you see wage gains at the end of the expansion, as profit margins drop and workers get a higher share, until businesses say, we can't afford it, you're fired.
Interesting.
And that's it. That is what we're heading. But it will take time. And
it'll take time.
Yeah.
It always takes time for markets to absorb that. And Dear, what do you expect over the next week in markets? Do you expect the banking situation to continue to get worse, or do you think that things will stabilize after a couple of days?
Yeah, I'm hoping that things stabilize. I'm not sure if you saw Hugh Henry's interview with Bloomberg, but I actually think that he posed a very important question, and it's the only way to stop deposit outflows. Does the federal government come in and do like what they do with hedge funds, where they essentially lock in money? And they say, like, you can't withdraw your money, or if you want to withdraw your money, you have to wait, 3 months or 6 months, or,
Right.
kind of, we'll call you back. So I actually think that's a very interesting question. Because I mean, at least with, the '08, there was something that the government could do. They could come in and they could backstop the MBS market.
Yep.
But what do you do to stop deposit flight?
Right.
That's I think the real question, and I think the only way to do that is by putting some sort of cap on the ability to be able to pull deposits. But then at that point, what kind of, I mean, you're kind of, I wouldn't say nationalizing the banking industry, but at that point you're putting massive oversight if you're telling people you can't withdraw your money, right?
Yeah, it's a temporary backstop, and that's what the Fed was designed to do, right? I mean, the Fed was designed to be a backstop for monetary policy and banks. I mean, I could be wrong, but that's my general understanding.
Well, that's the thing, and I'm relatively optimistic. I watched your interview with Bob, and I know that they were talking about some banks in South Carolina. Obviously, that's my home state. And there's one bank there. It's extremely well run. I mean, quarter over quarter, I think deposit growth's been about 10%. They are extremely conservative in terms of lending practices, and I mean it's been like kind of unnecessarily targeted because of everything that's happening. And so I mean I look at the regional banking sector, and I remain somewhat optimistic, but I do think in the next couple of weeks there could still kind of continue to be some pain, and I think some banks are going to continue to kind of be in the crosshairs of people within financial markets.
Yeah, and going back to Hugh's interview, I did watch it. He had me until he said that crypto is really the only way out of this. So tell me what you think about that. Like, is kind of crypto the solution to this? Sorry, I know people are going to hate me.
No. For me, absolutely not. But I mean, I don't want to say I'm a fiat maxi, but I think the fiat system works relatively well. I mean, but at least with what we have, there's no way that we go back to a gold standard, and I think that there's even less of a chance that we go to a crypto standard. But
that's clear, because then governments can't load up on debt, and they want to load up on debt. They want to spend money. They want to buy votes.
That's right.
Because that's how politics works. You buy votes, and therefore I think I mean it's in the nature of a fractional reserve banking that if there's panic, then it doesn't matter how good the bank is capitalized, because there's not enough around. And and I think now the problem is way too big, and it will, if something happens on a huge scale, then you got no other chance than to bail out the banks, bail out all of them, and just flushing them with money. You may unleash an extreme wave of inflation then, but that's the only thing to do, because the system, if it had been about 60, 70 years ago, and you said, if you do bad management, then we let you fail, probably banks wouldn't have lent out so much compared to the assets. But they did, and they learned that they will get bailed out anytime something happens. And
we set some bad precedents. We set some bad precedents in 2008 and 9, right? And so it's really hard to unlearn those. And at this point, should people today be punished for the bad precedent that was set in 2008? I actually don't know the answer to that, right? It's a really hard one.
Me neither.
So in general, is it fair to say, and I know Albert had to go, and I appreciate him coming on, but in general, do you guys believe there will be some intervention by the Fed and the Treasury to stabilize the regional banking environment, even if it takes an act of Congress to do? Dear, what do you think about that?
Sorry, I missed my internet got kind of glitchy.
That's all right.
Repeat it.
So in general, just kind of in the terms of the weeks ahead, maybe not the week ahead, you believe, is it fair to say you believe that there will be some sort of intervention in this regional banking issue to stabilize the regional banking environment, even if it takes kind of an act of Congress, which is actually what would be required to reenact that 2008-9 solution that we had to backstop the banks?
I mean, I think at some point they have to, and I mean it's kind of ironic, because we had Powell come out last week and say the banking sector's fine, and then fast forward to this week, everything's in chaos. So I mean I think that this is where, if you're the Fed, you have to start, and I've used this example a lot, because people are like, SVB isn't that big, or FRC isn't that big, but we're looking at that in like the American context, right? So if you took there's 6 large banks in Canada. If you took the 3 largest, or like the 3 smallest of the banks, Regions, which is based in Birmingham, Alabama, is larger than like all of them, right? So what we consider a regional bank for many nations is like large banks, right? So, what I worry about is if they don't backstop this and this continues to happen, one, what does the United States do where we have, 70% roughly of GDP is foreign direct investment inflows, right? Like foreign direct investment inflows as a percent of GDP, I think are about 70%. Where if you look back, almost a decade was like maybe 20 or 30. I don't have the data, but it's gotten drastically larger. And so how do we protect that foreign direct investment when people look towards us and say, this is a nation that has, relatively good kind of, rules and regulations in place to protect investor money, and that's why people invest with us. And now you look at the Fed, who's just kind of saying we're just going to let this, this dumpster fire run wild. What does that mean for the United States from an outflow perspective, as well as if they don't do something? Like this obviously has spillover effects, right? It
Absolutely.
no longer can just stay contained in the United States, right?
Yeah.
And so I think that's where they do have to, where Congress has to come together. And what always makes me laugh about that whole thing is even if you went back to the Trump administration, the Democrats were saying no, we need 2 trillion, and the Republicans were saying we need 1 trillion. But when you're talking about like really the difference between 1 trillion and 2 trillion, is it really all that important, right? So I said, is it really all that important? We're still talking about tremendous amounts of money, right? 2 trillion for one party, 1 trillion for the other. And it's just like, so I think that's where, they're just getting into gridlock to get in gridlock. But I think now if we look at what we have to do, making sure that we support the kind of these banks that provide funding to the backbone of America is extremely important. And I'll kind of land it here. If we talk about, productive capacity and real economic investments, that's what a lot of these regional banks do, right? If you're a farmer in Nebraska, you can't go to JP Morgan, because if you send off a loan application and it goes to some guy at JP Morgan, he's going to be like, a farmer in Nebraska, like, who cares, right? But that's where a lot of those regional banks provide that extremely important funding to that backbone that actually is what I would say increases total factor productivity, increases. And I know total factor productivity from an economic standpoint is a bit nuanced. Some people don't like it as a measure.
It's the same thing in Germany and Austria. We have a lot of regional banks, and then I think there are studies that this is a main cause that we have, and I think the US has also many hidden champions who, because they get the funding from the regional banks and they get treated, they know each other and they treat them like they're stars, so to say.
Because that incremental loan or that incremental business opportunity is big for them, right? It wouldn't be for a globally systemic bank. So guys, this is great. Thank you so much for this. Let me end this on this. I'm old enough to remember when the $780 billion TARP program was the largest program ever put out. And now we're throwing around $1 trillion here, $1 trillion there, right? so it's just really strange to see where 15 years goes and what happens over that time. So this has been hugely valuable. You guys have covered a lot of my thoughts about banks and a lot of my kind of questions. So thanks so much for your time. I really, really appreciate it. Have a great weekend and have a great week ahead. Thank you.
Thank you, you too.